Welcome back. Thought it might be helpful to take a look at the stock market from a couple of different angles because we certainly are in very unusual circumstances here. The white line's the S&P 500. This is from 2015 through present day, obviously hitting pretty significant highs. Now the histogram bars below, the red and yellow, red and white histogram bars below show us to the degree of these breakouts, meaning the longer we have to go back, the number of calendar days we have to go back in order to see a higher high or lower low indicates the severity of the potential breakout or breakdown. So currently with the S&P 500 above 4,500, we see we're flirting near 300-day highs. Now that obviously followed those very significant lows October of last year, S&P 500 and the 3,500 level, and that's when we saw 500-day lows. Now, before that we had 400-day lows, and then the S&P 500 broke down even more. But now we're flirting with very, very significant highs. So what does that mean? Go back to '07. We see here that the S&P 500 was trending right near significant highs, but then all of a sudden hit that low January of '08. That's around 1310. Those are 300-day lows, and that led to a much more significant breakdown. Here is where we are right now. We're not breaking down yet. We just actually hit the other day 38-day highs. The longer amount of time we have to go back in history to see a higher, lower low indicates the severity of that breakout. This is '07, the 1-year Treasury note yield we see hit a 509 yield. That's in January of '07. Those were 115-day highs. 1-year bond right now, well, it just came off a highs around 544, but prior to that, well, we hit almost a 5,000-day calendar day high on the 1-year US Treasury note. Huge highs. This is going back '07 to '09. The 10-year Treasury note hit a high. The yield around 520, 5.2%. That was a 230-day, 34-day high. Now, present day, 10-year Treasury, 406 yield. That was January 7th. That was a 92-day high, but that follows even more significant highs. The pattern that's important to note here is that the short-term yields, which are more reactive to the stock market, those are the yields hitting very significant highs. Speaking of short-term yields, take a look at the bond market. This is '07. We hit very significant highs, 527, and that led to the sell-off. The 1-year Treasury note moves very closely with the stock market. Well, this is where we are present day. The 1-year Treasury note hit highs, 4,600-day highs, currently sitting at a 537 yield. That's after touching 6% in May. Well, this is long term, where we are right now with the 1-year Treasury notes. Again, just off of huge 6% highs at a 544. The severity of this breakout is huge. And what does that mean in terms of macroeconomics? Inflation and the Federal Reserve reacting to the inflation. And the fact of the matter is they're expected to raise rates again. I think the latest probability show us a 96% chance they're going to raise rates in the next meeting next week. After that, there's a good chance they may raise rates again. Here's a 10-year note. Now, notice it's not having, well, it's hit pretty significant highs, but not near what the 1-year is. It shows us that the short-term yields are predicting short-term higher interest rates, but long-term, they see trouble on the horizon. Now, speaking of which, we also, in conjunction with the stock market, we consider instruments like the VIX, which is the volatility index. Now, in this case, this is the VIX Business Investment and Sentiment Index. It's a little bit different, but it tracks closely with our other fear indices. The VIX overall measures the premium on the short-term options on the S&P 500. When stocks go up, traders don't really need options, but when they go down, when the stock market goes down, I should say, traders use options to protect a position. So the premiums rise. VIX goes up when stocks go down. Well, notice, and obviously 2019, 2020, we had the crisis. The VIX sentiment indicator hit pretty significant highs, 395, almost 4%. That was 2019, 2020. Right now, the VIX indicator, it's low, but it has been ticking higher. Now we have a VIX Fear Index for different indices. The purple area chart, that's the S&P 500. The red line is gold. The green line is S&P 500, and the blue line is crude oil. Now these are not the indices. These are the VIX, the fear indexes based on gold, S&P 500, crude oil. Point being, they're all really at their historic lows. There's very little fear out there. As stocks chug higher, there's a lot of complacency in the market, which is good as long as stocks go up, but it also could be a danger sign. Now, what we have here, the white line is the average VIX. It's averaging the different fear indices. So investors who are buying either stocks in the S&P 500, gold, crude oil, NASDAQ 100 index, which is heavily technology weighted, or the Russell 2000 VIX, which is heavily weighted towards small cap stocks. And by the way, small cap stocks tend to fall first oftentimes in an economic crisis. You average all of those different fear indices, we're at historic lows. There's very little fear out there. Currently sitting on the average on a 19 VIX. Well, we saw a 21 VIX July of 2021. In fact, we haven't seen a VIX this low since 2019, prior to the COVID crash. Now, it's not to say that history will repeat itself stock market wise, but it's a pretty significant level. Here's the average VIX and the S&P 500 against its 30-day moving average. There's nothing special about the 30-day moving average, but it seems to capture the market quite well. When the VIX remains low, well, stocks go up, and traders buying near the moving average, well, that's not a bad position to be in. Here's the average VIX versus the S&P 500. That was 2020, by the way. This is 2021. The VIX spiked in 2021, but then settled back down. This is present day. Where's the average VIX now? Again, 15, just below 20. Look how parabolic the markets were. In 2020, the average VIX was around 25. In 2019, this is 2020, it was around 35. Present day, average VIX below 20. That's how significant of a low we are. So the point being is that there's a lot of complacency out there. Now, it does not mean to sell stocks because stocks are strong. And, rising tide lifts all boats. So we have no idea how long this market's going to rally. But just make note that the average VIX is quite high right now. And we also see the markets, including the stocks and short-term bond yields, also long-term, but especially short-term bond yields, are hitting very significant highs. Eventually, I think we'll look back and we'll say, wow, those are big highs we saw. But a market that's hitting highs tends to make new highs. Just exercise a great deal of caution because we're in somewhat uncharted territories. We hope this has been helpful. We look forward to seeing you back soon.